morning. We are half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Rebecca Choong Wilkins with David Ingles.
Good morning. Let's get to your top stories today. Asian stocks down on cautious signals coming out of the Fed, with minutes there from their last meeting showing that policymakers are ready to keep rates on hold.
And Alibaba's AI-fueled rally is facing a key test with earnings due later Thursday, even as concerns grow over fierce competition and China's slowing economy.
Also ahead, President Trump makes his most direct threats yet. Ukraine's Volodymyr Zelenskiy warning him to reach a deal with Russia and calling him a dictator.
Plus, a rare live interview with a senior official from Australia's central bank. We speak to Deputy Governor Andrew Hauser after the RBA's first interest rate cut in 4 years.
Good morning. Welcome to the show. Hope you're all well. We'll start things off with some breaking news. The loan prime rates out of China are out 1 and 5 year rates. 3.1% on the short end, 3.6% it remains on the long end. It certainly brings up the conversation that we are in the window for the MLF. And the reason I bring that up is in a moment, you guys will see the flattest yield curve in about 7 years in China. And certainly the reluctance, if we can call it that, to move short term on the short end is keeping rates in the short end very, very high. In fact, leading to that elevation there and the flatness of the yield curve. We'll talk about that in a moment. Just very briefly, risk off across the mood today across the Asia Pacific, with the exception of a few sectors which we'll get into in a moment here. So U.S. equities actually had a decent day. It's Europe really where we did see quite a sort of steep pullback across equity markets. S&P futures on your screens, a 10th of 1%. European futures bottom unchanged. A couple of sectors that we're tracking here today, some miners within the mining stocks and the mining complex. It's really rare earths, and we'll get to that story later on out of China. Possibly as well, and this is in Korea, media and entertainment stocks are bucking the downtrend there on this report that China may lift the ban on K-pop. At some point in the next few weeks or so. 2 and 10 year yields on your screen's bottom, and you have Brent crude as well, and of course also iron ore. We're back at the 107 handle as far as iron ore goes. Okay, just a recap of the moves overnight. We'll get to the Baba story in a moment here. There we go on Alibaba, 0.8 of 1% to the downside. A lot of earnings coming through today. List bottom of your screens, and going into the open today, 1 and 10 year yield as promised, and futures are pointing to, last I checked, down, and they are down 1/3 of 1% going into the, what day is it? Thursday session. Almost there.
Thursday session, but I mean, really the week has all been about tech and tech earnings in particular. Of course, as you hinted earlier, we have this host of earnings coming through. Alibaba, Lenovo, Bilibili, all of those coming through today. And elsewhere, to your point about this shift in tightening yields when it comes to looking at those longer and shorter dated bonds, we are seeing at that shorter end yields coming up, essentially leading to that flattening of the curve that Dave said. It's obviously a bearish signal, particularly when we think about the fact that we're going into MPC, the 2 sessions. So perhaps we may see authorities coming back to perhaps sell, for example, longer dated bonds. Anyway, that we might see them coming in to intervene in some way, try and sort of reintroduce a bit more of a curve into the curve. Elsewhere, rare earth producers, we're keeping an eye on that because China now banning essentially non-SOEs from going into and developing this space. A significant development, but I mean, in some ways in keeping with the focus on these sort of strategic assets. As well as that, finally, just an eye on, of course, we are still in this window for the MLF, and we're looking at some of this data coming through from Hong Kong and for Macau as well. Yep,
visitor arrivals are coming through, so watch for that. Right, as we were pointing out several times already going into the show today, so it's a lot about earnings, it's a lot about tech, it's a lot about Alibaba, of course, leading that earnings parade later today. Red hot rally, up 50% year to date so far. Now we get a real acid test here with earnings coming through in a couple of hours or so. Some analysts are already calling the company stock overbought. For more on what to expect, let's bring in our tech reporter, Belle, and also joined by Charlotte Yang, our Asia equities reporter for both sides of the stock and also the fundamental story. Belle, let's start with you. Take us through the forecast here.
Well, there's going to be a lot of focus on essentially how Alibaba can capitalize on the AI boom, because there's been a lot of positive factors behind the recent rally, and Charlotte can get through the details of those, but we've seen such strong gains. Now investors really want to know, okay, how are we actually getting money out of this? Because Chinese consumers don't really have such a great track record, like in other markets, but not really that willing to pay for AI services. So what are the ways that they're finding to capitalize on this? Fundamentals, as you said, that's going to be the key focus for these earnings this time around. What could be particularly focused on, or what will be particular watch, is the cloud business, because here analysts are projecting growth of around 9.7% for the latest quarter. That'll be up from 7% the previous quarter. And also for signals in the earnings call as well, how can Alibaba fend off those peers in the background? Because you've seen, of course, Alibaba's already integrated DeepSeek into its offering. So has Baidu, for instance. We saw Tencent, the rally earlier this week as well, off the same news. So the costs of entry are lowered now. So how can you really stand out from the pack?
Charlotte, I mean, we have seen this, regardless of all those sort of concerns that Bell has raised, we have seen this sort of rapacious tech rally in the Baba stock, 110 billion. And we are now getting JP Morgan saying that, you know, perhaps it's extremely overbought. It's maybe time to start trimming Baba. Just lay out what we've seen so far.
Yeah, I think for equity traders watching Alibaba earnings today, is like this you go big or you go home moment, because the setup is really tricky. You know, we're seeing Alibaba's Hong Kong listed stock has been overbought every session this month, and also its price has already surpassed the 12-month price target. If you think about it, like for so long, there's always that big gap, but now you're already reaching that 12-month price target, and also option traders, you know, expecting a bigger than normal one-day moving based on the implied move for the earnings. So, and also I think judging by share price reaction to Baidu's results yesterday, which, you know, they actually had that positive momentum in AI, but then traders decided to focus on the core business weakness, and the shares fell. So I think for Alibaba is that you have to be not only like positive, you have to be pretty strong results if you want to keep this rally going on in the near term.
Yeah, Bella, I'll bring you back here. The expectations are quite high going into this as well. Is there anything Alibaba can say to satisfy where the markets are?
Well, I guess they're going to really need to say something that indicates that they're actually managing to capitalize on DeepSeek, and they've got a plan around that. They're not the only ones that are sort of in this space and trying to do a similar sort of thing. Baidu, Huawei, Tencent, I mean, all of these are competing for the same amount of people, and this is a company that's very domestically exposed still, so it takes around 90% of its revenue from mainland China, which means it's particularly sensitive to ongoing issues in the property sector, weak consumer sentiment. So I guess anything they say in that area as well. Taobao, Tmall revenue, they're going to be something really closely watched. We could have seen perhaps gross merchandise value that could have got a bit of a boost from recent holidays as well, and investors also going to be looking for any sort of guidance on how they plan to fend off any sort of trade war as well, because we've seen that concern perhaps we're going to see greater tariffs being put onto Chinese companies. What they say in this sort of area as well could be very interesting.
Nonetheless, we are still seeing this AI rally kind of pervade through markets, and we have seen Morgan Stanley most recently upgrading their MSCI China estimate, but target, but we've also seen, you know, others doing similarly. I mean, is that a surprise, I suppose, and are we expecting to see more follow?
I think we're definitely seeing, Alice, from, you know, the sell side, like Wall Street banks, they've raised their targets for the various China benchmarks, and starting with Goldman Sachs, and then we have Morgan Stanley. But I just did a quick calculations. It's about like a little more or less 5% upside from now on. And I think, you know, what matters is that, you know, just because of how China investors trading these days, it's like, you know, you trade something like a 5-year starting like a 5 weeks time. So I think what's matter is going to think not just the one step or two step ahead with AI, always like, you know, the consumer recovery, but like 3 or 4 steps ahead. So which is why I think, you know, Alibaba, given that such a, you know, it's a huge exposure to China consumption recovery, why the results will be so important.
All right, team, thank you so much. Charlotte Yang there and Bell covering the Alibaba story. To the point they were just making, we just showed you, of course, just Morgan Stanley, Goldman Sachs, and UBS, the latest, to also just upgrade their targets on MSCI China. UBS, by the way, joins us later on at about the open there as well. To the point that Charlotte was also making, just to briefly touch on that as well, right? JP Morgan effectively saying trim your Alibaba exposure because it's overbought, and it's really top 4 within the top 5 right now. Will Semiconductor actually takes the title here on the 14-day RSI at about 90 within MSCI China, to be more specific. Futures are pointing down going into the opening today.
Yeah, and coming up, still this focus on tech for us. I mean, China's AI star DeepSeek might be looking for outside funding for the first time, and interested parties are lining up. We'll get you all the details about that forthcoming story up ahead. And we are counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. You're watching The China Show.
Welcome back. You're watching The China Show. Get you guys an update right now of the big news overnight between President Trump and President Zelensky. So President Trump has stepped up his attacks on Ukraine's president after earlier labeling Volodymyr Zelensky a dictator who won't have a country left unless he moves fast on a deal with Russia.
I love Ukraine, but Zelensky has done a terrible job. His country is shattered, and millions of people have unnecessarily died. And you can't bring a war to an end if you don't talk to both sides. You got to talk. They haven't been talking for 3 years. So we hope to see a ceasefire soon and to reestablish stability in Europe and the Middle East.
And just some context that the president was speaking at a Saudi-run summit in Miami. Let's bring in John Harney, our Bloomberg News editor, to talk us through the nuance here, if any, out of Washington. I mean, John, we woke up in the Asia Pacific this morning and we were thinking, what is going on? Is this posturing? What do we know?
That, as with so much of what Donald Trump and his administration say and do, remains to be seen. But it represents a stunning reversal of the U.S. position in what has been a very close relationship since the war, which began nearly 3 years ago, and is about to enter its 4th year. This presents, of course, a very stark choice for President Zelensky. How does he move forward without, so it seems, the support of a very crucial ally? And this, of course, has echoed around the world with allies of Ukraine and up on Capitol Hill, where many, even Republican lawmakers, rejected the idea that somehow Ukraine was at fault for starting the war, which is what the president indicated in his remarks.
John, elsewhere, we've also had President Trump saying that he could redirect some of the savings from Doge to U.S. taxpayers. What details are emerging from this plan? And are the sort of very ambitious goals that have been laid out by Musk and Trump in terms of Doge savings, are they actually achievable?
Well, first of all, during his speech before the Saudi investment fund down in Florida, he went over a variety of topics, including Ukraine, by the way. But the amount of savings is itself in dispute. He and Mr. Musk and others have said that they saved $55 billion, I think it is. Our figures indicate it's more like $8 billion, which would mean about an $11 refund that would come back to the American taxpayers per person. So this is all a work in progress. On his way back from Florida on Air Force One, the president signed a new executive order giving Doge yet more authority, this time over review of regulations. So it's all unfolding as we speak.
OK, John Harney, Bloomberg News editor, thanks for joining us this morning. And later Thursday, US Treasury Secretary Scott Bessent will be joining Bloomberg Surveillance. That interview is happening at 8 p.m. in Hong Kong or 7 a.m. if you're in New York. In some geopolitical stories we're also following this morning, President Trump's eldest son says the US should be prepared to deal with any military challenge from China, yet remain open to talk with its rival. He made the remarks in commentary for a conservative news website. The piece also made the case for Elbridge Colby to be nominated to a Pentagon post. Colby is a hardliner on China and the president's pick for Undersecretary of Defense for Policy.
Right. China plans to ban private companies from mining rare earths, further tightening its grip on a strategic sector in this trade war with the United States. Now, Beijing is drafting rules proposing that only large state-owned groups can mine, smelt, and also separate the minerals. Now, rare earths are used in everything really from wind turbines to EVs and have been really a part of China's past trade disputes. Okay, just going into the open today, and yeah, it's a bit too early to look at this, but just a reminder, I guess, of how we closed the session yesterday, just below 23,000. Do expect us to open slightly below that level today, given the downdraft we're seeing across the region. The Nikkei is, in fact, now down about 1%. Oh, there we go. 0.2% on A50 futures, and of course, we're focused in on this yield curve. We're back below 170 on the 10-year, but of course, we're closer on the 1-year. Opening bell, 11 minutes away. This is Bloomberg. Right, welcome back. So Chinese AI startup DeepSeek is said to be considering, get this, raising outside capital for the first time. That's according to a report out of tech outlet The Information. Let's bring in Min Min Lo, our China correspondent, to talk us through this. So, yeah, what do we know about this, the fundraising plans here of the company in focus?
Yes, so the founder, Liang Wenfeng, he is said to be quite reluctant to seek outside funding because he doesn't want the added pressure to have to commercialize its products too quickly. But now The Information is reporting that after DeepSeek's shot to fame in January, we have seen how users spiked and there had been outages, and that really raised the issue of how DeepSeek needed to improve its infrastructure, get access to more chips, more servers, and also support the development of its AI model. So now it's considering to accept outside funding, and the quarters include Alibaba, for one, as well as some other state-owned funds like China's Sovereign Wealth Fund, China Investment Corp, as well as the National Social Security Fund. But it's not clear now what direction the founder will take the company into, because there is a dilemma there. If he accepts funding from a state backer, that raises the national security concern that the U.S. would have on this app. And already we have seen the U.S. Introducing a bipartisan bill looking to ban DeepSeek from government devices. The U.S. Commerce Department had recently also added another Chinese startup, Zhipu, onto an export control list because alleging that it is contributing to the Chinese military because it also has state backers that are funding it. So these are some of the risks that maybe DeepSeek would have certain limitations expanding into the U.S. if it accepts funding from state backers.
If DeepSeek chooses not to take up state-backed funders, as well as perhaps decides to eschew all Chinese investors, does it have an alternative?
So right now, the app is funded by the parent hedge fund company called Highflyer, which is also founded by Liang Wenfeng. He started it in 2015 to look for an AI solution for stock trading, which at the time was very novel. Now it's facing a lot of competition from other quant funds. So it's not clear how long the parent company can continue to fund all of DeepSeek's capital needs. It's going to face challenges raising funds from U.S. backers as well, because the U.S. restrictions of investments into Chinese AI companies had also kicked in last month. So the company is also mulling shifting its focus away from pure research and development to building a revenue-generating business and eventually a profit-making business. But we're still a long way from that because the app is now free. Its programming interface is extremely cheap, a fraction of what ChatGPT charges. The recent partnership with Tencent to test some of these AI features in WeChat, not clear how much revenue that would bring to DeepSeek as well. So still a lot of questions about what sort of risks it's willing to take in order to get more funding.
Bloomberg's China correspondent Min Lo there with us and we'll have more analysis on DeepSeek and China's AI development in the next hour with TidalWave Solutions senior partner and NYU professor Cameron Johnson. Stay tuned for that. And some stocks that we are keeping an eye on today. That includes BYD. We've had JP Morgan hiking its price target for the EV maker by about 26%, up, well, and close to nearly 2% there higher. And it's really a bet about BYD's longer-term story. The phrase from JP Morgan is that it could become the Toyota of the global EV market.
Wow. Okay. I mean, just to put that into context, right? 600 is clearly at near the top end of the range of forecasts. The only forecast that is higher, the only house that has a higher projection on BYD is actually Citi, and get this, closer to 700 pop here. Anyway, 60% is the implied rally coming through there out of JP Morgan. Prada is also in the news today. Let's look at what the stock is doing, and that's on this report that it's maybe looking at a possible bid for Versace.
Yeah. Prada was an interesting story as well. One of the sort of few stronger players amid this broader downturn in luxury. Interesting that they're sort of trying to take advantage of this moment to see about potential acquisitions.
Yeah. Some bargains in the luxury space. UB Tech is out with a cash call right now. The share placement is... So this is interesting, right? So the stock price has rallied close to about 100 from really far from that a couple of weeks ago. And then the company's coming out and striking while the iron's hot and coming in with 914 at $90, right? So interesting with the stock price moving up while it's getting a discount. But yeah, timing is essential when you look at these things. Right, going into the open today, just under 4 minutes away, in case you missed the loan prime rates, 1 and 5 year, no change. We are seeing a pullback, material pullback in the early goings of today. 1% on the tech index. Meituan is down about 5.8%. We'll talk more about that stock in a moment. And a lot of the, certainly other brokerages that have come out with their commentary on the AI story. The latest one is actually UBS, and James Huang and his team there have basically come out and said the bets there around AI still have room to grow despite the rising crowd. We'll speak with UBS, but his colleague coming through, Eva Lee, joins us in a couple of minutes to talk us through their separate take on these markets. The opening bell is just ahead. This is the China Show.
Good morning and welcome back. You are watching the China Show. We are seconds away from the open of markets. We'll just take a quick peek. A50 turning positive, slightly, very, very marginally, Dave.
I like how liberal you are using that.
Yeah.
4/10 of 1%. No, not even 4/10 of 1%. 4/10 of a tenth of 1%. There we go. But, you know, on a day like where habit has really become looking at the sort of the half-full, glasses half-full version of things right now, it is, we are seeing a turnaround there in that specific contract. Although really, a lot of the action recently, we've been talking about this, that the concentration of the rally has really been in Hong Kong, and really the select group of stocks. And it really comes to head with Alibaba reporting today. And if we judge the reaction as far as the options market and also the reaction to Baidu, don't get your hopes up, I guess, is the takeaway there. Oh, thank you for the zoom out. Okay, a tenth of 1% to the downside on the CSI 300. Perhaps more encouraging here is turnover is actually a 10th straight day above 1.5 trillion renminbi onshore. So that's, I guess, in one way is very constructive. You are getting a pullback there, though. The story, though, recently in the onshore market has been the flattening of the yield curve, which is now at a 7-year low on the spread of the 1 and the 10. And also the property price numbers, which came out yesterday, further green shoots, and maybe our guest can comment on the real estate sector in a moment as well. She used to cover real estate there, apart from the equity markets. The Hong Kong markets are also coming online right now, and we are getting a pullback there, 1%, 240 points at the Hang Seng Index. So Alibaba, Lenovo, NetEase, Bilibili are those that are coming out with earnings. Today, Morgan Stanley, the latest house to come out with their revised forecasts on these benchmarks. Hang Seng Index 24, MSCI China's in the high 70s, I believe. There we go, out of Laura Wang and her team. I think Goldman actually has an 80-plus handle on their latest forecast a few days ago. Right, a glance at some of the big movers coming through, say Bilibili, NetEase, I mentioned that. Prada in focus on this report that it might be considering a bid for Versace, and we're down about 2.7 there. And UBTech is unsurprising given the cash call there at about $90 per 8 share. All right, very, very quickly, rare earth miners in focus on this, I guess, this move. And unsurprising, but it's, I think, more clarity and what this might mean here as far as supply goes and who's buying the supply. Large state-owned firms, and you are seeing a pickup there across some of these big names, Rebecca. Yeah,
to your point, Dave, let's bring in Eva Lee, Head of Greater China Equities at UBS Global Wealth Management, Chief Investment Office. I mean, let's just start, I think, with the obvious question that we've been chatting about this morning, which is the AI-driven tech rally.
Yep.
Is it overbought?
Well, I have to say, if I have to describe, like, from January low to now, 30% up on the China internet names, I would say probably that 60% is purely sentiment, improving on China as a whole. 40% is pure AI. Because the reason why I said so was, if you look at the overall China, take away the internet names, i.e. MSCI China ex-internet, actually this is how much the rest of the China stocks have gone up by. So that gives you a perspective, like, so 30%, the rest was up like 17%, something like that. So that gives you a perspective as why internet names. Obviously, the low valuation was the reason. Remember some of the leading e-commerce portal that have gone up 50%, yeah. They were at 9 times PER. 9 times, and the earnings for the next 2 years is mid-teens. So it's like, hey, not even 1 times PEGA, PE to growth ratio. I think there's something that is very under-owned, oversold, and as a result, when the momentum coming back, people say, hey, let's look at what they do, and then the valuation was so low. So these inflows coming in, and that lifted the valuation. So yeah, a long answer to your question.
Is stuff still cheap?
If as an internet as a whole, I think right now I'm saying roughly 14 times for PER. Again, back to the mid-teens earnings for next 2 years. So we still, we're not saying expensive, but that run up, definitely makes some of the investors not too comfortable because there would be some profit taking, no doubt, and there will be volatility ahead because the AI story is just the beginning. We are seeing the breakthrough. The key now is fundamental. Are we seeing some monetization from this AI? We have one company announce the results. Their cloud growth definitely surprised on upside, but the margins was not so encouraging. And the entire space now going open source, free of charge. Are some of the players going to be affected by these sort of new trend? I think there will be a lot of sort of up and down in the near term. So back to your question, it's we still see high single digits on the overall China internet space. We had sort of mid-teen to 20% before the rally, but obviously now we have less upside.
That's a good point to bring up because, as you mentioned, right, AI is still in the early stages. And if you look at, say, the Mag 7 in the U.S., they're clearly, it's not a monetization game, it's a CapEx game still. Do you think the market understands that? That we probably won't get promising guidance coming out of big Chinese tech firms on what the revenue boost looks like because the pessimistic side would argue it's too soon to be able to model that anyway.
Well, in a way, I think this is actually one of the key questions majority of the investors ask me, particularly among the U.S. names. When we will see the monetization and applications really start to benefit from this AI story. Yeah. But if you look at China AI story, I think cloud growth, we were sort of behind the space, I have to say. And also the amount of money people put in crowd were behind, the US peers. But one thing we are different is application. Remember, the e-commerce, the gaming portal, they have been using AI to improve the attachments of their consumers. And also the ad tech. Remember, they have been using AI to do the more of sort of targeting advertising, what we call the ad tech development. So all these they already apply. It's just that they do not be able to separate. Okay, this is a portion that rely on AI. I got an improvement on advertising earnings, but actually on application-wise, they probably not too behind, the US peers.
At the end of last year, the last quarter, we saw quite a hefty withdrawal of US hedge funds of investment in Chinese stocks, which speaks to the difficulty in timing this market. Who is buying this rally, and do you think it is this DeepSeek AI moment, is it enough to bring back US capital? And I'm thinking kind of longer-term US capital.
From what we understand in terms of the inflow, particularly since Chinese New Year, actually it was led by the U.S. long only. Okay, that's one thing a big phenomenon is long only have returned to the market, but doesn't mean that long only can stay forever. And also we were very under-owned. There was at one stage, our firm has done a survey on top 40 global institutional investor. Before this rally, basically was year-end, their position in China is only 1%. MSCI benchmark is 2.7%. So this is how under-owned China they were in. So when they hear this news, it's always the case. The people that, away from, the happening, they actually have a clear mind and they put the money earlier. We had that before in the past rally. So this is the same similar scenario. And obviously, following that, the APAC long only also coming in. So if you ask me the quantum, probably maybe the APAC long only were the biggest supporter relative to international, but U.S. ones were the ones coming back. But I have to say, to answer your question, we still have we have tariff, we have Trump saying different things, every day. We have the policy response that are known on March 5th meeting. All these would affect how much more long only international as well as APAC long only, how much they want to put in or additional put in onto China market.
That's a good point about needing more information, because you did have a recent report out on the tech symposium that we saw between presidency and private entrepreneurs, and you titled it Rich in Symbolism, which begs the question, is it lacking in material substance? Do we need to see something more substantive and more follow-through from the government in order to give investors that conviction that there is support for the private sector?
Well, yes, definitely. I mean, we actually have been lacking this. Remember, last year, particularly before September, that was the issue. Government saying support of the market without actual measures, without, sort of execution. That was the issue. But having said that, why I said rich in symbolism, it's because this is the second meeting since 2018. And on top of that, since 2021 till maybe 2023, we have a few years of lots of regulatory changes. A lot of these sort of new economy companies are adapting to all these changes. So now, with presidency coming out, recognizing their contribution to the economy, highlighting that, how we're going to grow our economy forward, which is relying on this innovation side, I think that's a very important, vote of confidence on this sector. So I think that's why I said, and at the end of the day, China is always, you have to read, between lines of what leaders is seeing and viewing, particular sector.
Yeah. The 2018 meeting, Rebecca and I were talking about that this week. A lot of people missed the tea leaves on that one. And then here we are. So can we at least say that the regulatory story is for now behind us? That's that premium, that's the crackdown story. Yeah,
I think they are now at least at a stage they are comfortable with the current setting. Okay. And they expect expect all these leading companies to follow the rules, which they already have. And in fact, one thing we have to understand is a lot of these companies, based on this rule, they have changed the operation side.
Right.
And that's actually, and still be able to squeeze more margins out of it. I think this is something that's positive on these Chinese internet companies.
Okay, we'll have more with Eva Lee joining us in a couple more minutes on the other side of this break. Out of UBS there, of course, Global Wealth Management Chief Investment Officer will be staying with us as well. Right, later on Bloomberg Television, so we had the RBA decision this week, first cut in, 4 or 5 years. How much more? Can they take rates down? We'll be joined, of course, by that name on your screens at those times, on your screens as well. Do send your questions in if you have anything burning there, and we'll try and, of course, get that to Andrew Hauser in a couple of minutes. Stay with us. This is Bloomberg.
Eva Lee, Head of Greater China Equities at UBS Global Wealth Management Chief Investment Office, is back with us. Eva, I mean, the other side of the story about tech is really the story about consumer demand and what is going to shift confidence in China. A huge part of that story, of course, is the property story. Are we starting to see any green shoots?
From the data that we analyzed, we noted that the months of inventory for the top 80 cities have finally coming down. And the tier 1 cities, months of inventory actually back to historical average. But this is a data that stock divided by past 3 months of sales. So the stock can increase. But one thing we can be, sort of more positive, it's if you look back for the last 2 years, land sales have come down a lot. Property under constructions have come down a lot. So as a result, we can see the stock, gradually improving with the sentiment coming back. They will push more stock out, but it's not unlikely that it will exponentially increase from here. And one more thing, it's even when we sort of looking back at the data, even without any further measures, if the sales, sort of stabilizing, returning, we should see sort of the market sort of hitting the bottom, which is like continue less decline, coming, will be in second half of this year without any further measure. Because this is a natural, sort of the market gradually already have corrected a lot in terms of sales, constructions, and all that.
Do all these feel-good stories, property for one, the DeepSeek story number 2, the worst-case scenario on tariffs perhaps not being on the table yet, hopefully that's the case, does that reduce, do you think, the urgency for policymakers to support this economy? Because I'm looking forward to the 2 sessions in a couple of weeks, and a lot of people are thinking, do they still need to come out with a big number there to support this economy? Because it seems, to your point, things seem to be healing naturally.
This is actually my concern. In fact, because we understand that the U.S. review of tariff policy will not be announced until April. So, and they have been sort of responding to the U.S. side in terms of pushing more policy to stimulate the economy. So there could be a potential that they would talk about it, how they support, which is exactly like overnight. There is another news talking about they support consumptions through, the auto and all that. But they might say so, but actual executions could be gradually rolled out depending on what U.S. do. Okay. Yeah, so that's like if market, but good that the market has not, sort of priced in that a lot, but that could be a factor that could trigger volatility in the market.
So exports make up about 1.5% of GDP growth, at least for 2024. Is your assumption that if we don't get that huge big tariff hit in the next few weeks before the MPC, which who knows with President Trump, but if China isn't able to anticipate what kind of hit it's going to see from tariffs, is your assumption that they won't roll out a number to sort of anticipate the potential hit because of exports and tariffs?
Yeah, I think this is it's not about the export. I think it's also about sentiment as well, right? Because if you look back as what you described, actually our reliance on U.S. export to U.S. has reduced compared to 2018. But let me go back to the base case scenario. Our base case is 10% before Trump. The tariff is going to increase to 30%, okay? So the impact on the 2-year GDP is roughly 1%, 0.7 to 1.2, so roughly 1% of GDP. So this is the actual impact. But anyhow, what's the second derivative, which is important? It's a sentiment impact. So as a result, going back to your question is, if Trump hasn't clearly push out the tariff, then they should wait. I mean, naturally, if as a political leader, they should wait and see what Trump is going to do, and then they sort of react accordingly. So that's why NPC might not pull out everything from their pocket to support the sentiment or economy.
So what's the advice now, net? Is it lean into risk even further, or is it worth considering now some of the cheap defensive hedges right now, strategies in this equity market?
Yeah, given how fast the market has moved, obviously we need to look at which are the ones that are a bit high on valuation and switch and do the rotation, even within the internet and growth sector. And on the other hand, in addition to it, they should build into some of the yield story, like the financial, particularly the financial. We expect the banks is likely to surprise on upside for the fourth quarter earnings. And also, this is a dividend season.
Yes.
Right? I mean, the financial, the energy, the telcos, they're going to give you dividend. So that will give you some sort of, protections against this volatility. Because I think yield is still, we're talking about 6%, 5.5% dividend yield. Pretty good to pocket that in. Yeah.
That's going to be confirmation, really, of a winning strategy, right? Eva, thank you so much. Fantastic to speak with you. Eva Lee, the head of Greater China Equities at UBS Global Wealth Management Chief Investment Office. And some other corporate news that we're tracking today. Apple, let's start with Apple here, has unveiled a new low-end smartphone called the iPhone 16e. It's priced at just under $600 USD. It aims to revive growth, of course, after a sluggish holiday season. And the product also includes the in-house cellular modem chip, replacing a key component from Qualcomm in a long-awaited shift.
And elsewhere, Grab's shares tumbled in late trade after it predicted full-year revenue that trailed estimates. Grab expects up to $3.4 billion in sales this year against the average projection of $3.5 billion. The outlook suggests caution around a Southeast Asian ride-hailing and food delivery market where GoTo Group remains a formidable rival. And we'll also be hearing from Grab's CFO later. For more on the company's guidance, catch that interview on Insight with Haslinda Ahmed at 11:15 in Hong Kong or 2:15 p.m. in Sydney. Stay with us. You're watching The China Show. This is Bloomberg.
Welcome back. You're watching The China Show. Good news if you're a big fan of K-culture and K-pop here. So there is a report out of I think it's the Economic Daily, that maybe officials in China are looking to lift this ban on K-dramas as early as May. And as you can see, markets are reacting quite substantially to this. These are some of the stocks-related media and entertainment names listed in South Korea. Just to really underscore potentially how large of a market China really is, and really the various iterations of potential future revenue streams that could be realized if we do head in this direction. Watch this space, no pun intended, very, very closely. Now, if this doesn't excite you, this next story will.
It?
Yeah, yes. I served it up on a plate, right?
Okay. Rare earths,
yes.
That's what we're looking at.
Why not?
Essentially, the focus is going to be on Chinese SOEs developing these private firms, essentially kind of just ruled out from playing in this market now. It's sort of understandable in the context that China is increasingly doubling down on controlling and trying to sort of oversee these really strategic minerals and really strategic commodities, and particularly this supply chain question.
Yeah, we're seeing that play out across the equity markets on your left as well. I mean, this should really come as any large surprise because this really is one part of the trade war conversation that China's really leaned into. So again, watch this very closely. Now, so we've gone from entertainment and media to rare earths and now to some of these consumer and tech-related stocks in focus today, going the opposite directions. And Meituan is, so JD actually, this was a story from a few days ago, I believe, with JD.com in focus there. But now it's Meituan will be rolling out, expanding effectively here, social security protection to full-time and some part-time delivery people, and the plan will potentially impact its unit's economics, but help strengthen industry positioning according to the takeaway from analysts here.
Good morning and welcome back. You are watching The China Show. Here's a look at the HSI. About half an hour into the session, we are down about 1.5%. If we stay at these levels, it's going to be the worst day in about a month or so, and perhaps a little bit of profit taking. But of course, we have seen such a sort of rapacious rally in this market, you know, really driven by just a handful of names in focus again today because of tech earnings. And it's all about the AI story. It
certainly is. So you had Baidu earlier this week. Alibaba reports today. Lenovo is actually the hardware play on the AI story. They're also reporting later today. Bilibili, NetEase, and I think to Rebecca's point, there's a name, the list of names on your screens that are in focus today. I mean, we're getting more analysts and strategists coming through and chiming in. I think Morgan Stanley was the latest one to upgrade their targets on MSCI China and the Hang Seng Index. So really, it's become fairly fairly hard work, a lot of hard work, and a bit confusing really to browse all this various fora of literature over the present situationship of this market between pricing, valuations, AI, and future revenues. The story across Asia-Pacific, by the way, so apart from this, we'll talk about rare earths and also K-pop in a moment. The benchmark is down about 1%. A lot of that is really because of the tech story playing through. Pullback as well on S&P futures. Wow, that's quite a sizable move. We don't normally see that kind of move this time of the session. And European futures, bottom of your screens, following just a really, really bad session on the Wednesday. US 2 and 10 on your screens. Aussie and Japanese yields also to the downside right now. So stay tuned for our interview, of course, with the RBA in about 10 minutes or so. Right, for some context on what's going on today, Mark Cranfield is with us, and he's with us out of Singapore for just more context. Mark, bit of profit taking. Is there anything else here?
Well, the Fed minutes were quietly dovish because they spoke about they may try to slow down quantitative tightening. They've been reducing their balance sheet for some time, and they look as though they're trying to find a way to stop that. Now, they're saying that within the context of the new policies which are coming in from the White House, they need more time to assess that. There could be inflationary impacts, and then maybe they should sit on their hands for a while. Well, if you look through all that wording, if they are going to stop balance sheet reduction, that means more liquidity in the markets, and that's, in a way, that's a stealth easing. That's something investors were not expecting before they saw the minutes last night. So the follow-through from that we're already seeing in financial markets this morning, especially with the US dollar. If you look at what's driving the markets, dollar yen is the one that's leading the markets here this morning. And that is partly because slightly more dovish Fed minutes than expected. But on the other side of that, also, the hawkishness from the Bank of Japan is building up as well. So we've had Bank of Japan speakers recently. Takata was the latest one yesterday. And the most important thing that traders are hearing is that they're not pushing back against higher JGB yields. JGB yields have been climbing pretty steadily for a few weeks, and the Bank of Japan is not telling you that it's wrong. But in effect, they're endorsing higher yields in the market, and that's starting to get people thinking that the next rate hike from the Bank of Japan is actually going to be pretty early. So it wasn't too long ago that we were talking about a hike in September. We're now 50-50 for one in June. That could come even nearer because we're talking about a CPI number tomorrow, which might be 4% for the first time in 2 years in Japan. So if you add The Bank of Japan factor with the FOMC minutes as well is negative for the US dollar. You've seen that play out this morning. It probably puts a bit of a dampener across equity markets as well, which are also, of course, focused on Alibaba today.
Yeah, I mean, I want to ask you about Alibaba. We did finally starting to see amid a range of upgrades on price targets for various Chinese indexes. We are also getting commentary from JP Morgan saying that Alibaba, among other AI proxies, are overbought. Do you think we're sort of starting to see that kind of caution coming into the market today? Are we starting to see this rally start to stutter?
It's a threat to your rapacious rally. I mean, we're getting a situation where Alibaba is a bit like a NVIDIA event now. Equity traders are used to the days when NVIDIA reports earnings have become major events for the US markets, and now it looks as though Alibaba is doing the same in the context of the Chinese and Hong Kong markets. And it's not surprising. If you look at what's happened in the past few weeks, the Hang Seng Index and Alibaba have gone up almost line for line. It's clearly the biggest stock in the Hang Seng Index. It's clearly been driving sentiment, and a lot of it, as you've been saying, is related to the AI story. Now, when people look at the numbers, with all that euphoria built in, it's going to need a very positive outlook from Alibaba to satisfy all the people that have piled into the market in recent weeks. Now, they may be able to, because we've seen NVIDIA has done it many times. Just when you think that the market has pushed NVIDIA as far as it possibly can, out they come with their earnings, and they beat estimates, or they give a very, very positive outlook that satisfies people anyway. That may well be the case today, even though it looks as though some people want to take some money off the table in case Alibaba don't meet expectations. We might get a nice surprise tonight. We may well hear that Alibaba sees the AI story as really only just beginning, that there's a lot more earnings for them to come from that area. Whichever way it goes, the stock is big enough in itself to move around the Hong Kong market quite a lot. And that is clearly, of course, they report after the Hong Kong market closes, so the first reaction will be with the ADRs tonight in the US, but obviously there'll be a follow-through to Hong Kong markets tomorrow. It is now becoming a bit of an NVIDIA event for Hong Kong, so watch out on Alibaba days.
All right, finally, it's our opportunity to move into that spotlight, Mark. Thank you for that. Mark Ranfield there, our MLive strategist. Speaking of the Alibaba story, so shares, as we were pointing out, is down 4%. We're still up 45% year to date here. Let's have a look at the options market, and Annabelle is here to take us through specifically on Alibaba. We'll get to the earnings and forecasts and some of the other subplots in a moment. But yeah, what's the options market telling us about how the market's positioned ahead of the earnings?
I think that the options market is telling us we're going to see a big move in either direction, essentially, because options pricing is telling us that we could see a 6% swing in either direction, and that's a lot more elevated than we've seen in past quarters, say the last 8 or so. You're looking at pricing of around a 4.8% move, so it's definitely more elevated than what we see typically. And I think to Mark's point there's just so much anticipation around these numbers such that you can even start to say this is the Hang Seng's NVIDIA moment. But in terms of what we're going to be getting today, or the focus for today, it's very much on the fundamentals for this business, because you think about what's really driven the rally, and it has been, I mean, it's been red hot, really. We're up around 60% from the January low. We've added around $110 billion of market cap. And there's been a confluence of positive factors. You've seen DeepSeek, so that's really driven a lot of optimism around Chinese innovation generally. You've seen Apple now teaming up with Alibaba to roll out Apple Intelligence in mainland China. You've seen Jack Ma meeting top leaders as well in the country. So these are all positive factors. But actually, how is the business trying to monetize this, and how they're actually getting ROI from AI? That puts a lot of focus on the cloud business in particular. Analysts are projecting revenue growth around 9.7% for the quarter. Again, it's up from previous quarters. And in the earnings call, you want to get any sort of signals, again, how they're capitalizing on not just DeepSeek, but AI generally.
I mean, that's a good point about this emphasis and focus on the fundamentals here. And when we think about earnings, where specifically are investors kind of most focused in on?
I think, yeah, it's going to be that AI portion, cloud business definitely. But I think as well to note, the bread and butter of Alibaba is the e-commerce division as well. And this is a company that we've been discussing. It's very exposed to mainland China, the economic story there, weak consumer sentiment. And you can see that in the sales, for instance. I mean, they've been in single-digit territory for really a period now. And so you're going to have a lot of focus on that. So Taobao, Tmall revenue, actually that's expected to have risen around maybe 2.1%. And that would have been around from 1.6% a year ago. So again, better numbers there. Did they get good holiday spending sales, for instance, something to track? But this is as well a business that runs the risk of the escalating tensions between the US and China, because we've already seen, for instance, these planned imposition of US duties on smaller package now from Chinese players or Chinese sellers to American buyers. How does that end up impacting Alibaba, for instance? There's a lot really to listen to in the earnings call later today.
OK, well, we'll be listening, Belle, and I'm sure we'll be listening to you tomorrow. Bloomberg tech reporter Annabelle Drewler's there. And next on Bloomberg Television, we'll ask RBA Deputy Governor Andrew Hauser why policymakers remain cautious about easing after cutting interest rates this week for the first time in 4 years. That live interview is coming up, so stay with us. This is Bloomberg.
We're looking at some Chinese computing stocks trading slightly to the upside, moving against the grain here. Well, the big story in the industry these last, let's call it 12, 18 hours or so, has been this, well, the milestone coming out of Microsoft, with the company saying that it has achieved a major one in its quantum computing efforts, unveiling a chip called Majorana 1. Yeah, the Executive Vice President, Jason Zander, telling us more about the product and its potential uses.
One of the best use cases that we see is going to be in places like chemistry. That's a place where we use even AI now. We're using to discover new molecules and build new things. But AI is just an approximation. A quantum computer actually speaks the language of nature, which is quantum mechanics. That's what makes it so powerful. So when we combine those things together, we're going to be able to do brand new things. Like I said, I'd love to get rid of forever chemicals. I would love to get rid of microplastics. We're going to need to invent new technology to be able to do that. Quantum computers are going to be able to help us accelerate it. And it's just not something you can do on a classic supercomputer.
Let's talk about the competition, because Microsoft isn't the only one developing its quantum computing chip. Google unveiled their own in December called Willow. Theirs has 105 qubits. Microsoft is harnessing about 8. Talk to us about how we can stack these up against each other. Is it a count the qubit kind of race, or is Microsoft doing something different in the approach that makes it better?
And when you talk about qubits, there is sometimes this race in industry say that I've got a ton of qubits. The real interesting question at the end of the day is, what can you do with them? And so I could have 1,000 qubit, but if they can't finish an actual quantum workload, an application, it really doesn't matter. Or if it takes 1,000 years to finish that application, it kind of doesn't matter. And so at the end of the day, what's most important is not the count of qubits. In some ways, that's kind of a vanity metric. That's for any vendor, not just Google, but it's true for everyone. What really matters at the end of the day is, can I get to that high count but make them useful? And that's the value of this topological conductor that we've got, this topological core. These topological qubits have error resistance built in. They're small, they're fast, they're digitally controlled. There's just no one else that has that. So we can get to the scale and we can make sure that they're useful. And like I said, today you're going to start off with a small count, just like transistors originally. There weren't that many of them. There were tons of vacuum tubes. Over time, you're going to get that transition and that scale. That's what's going to help. In 20 years of experimentation to get us there. Now starts the real race to go make the volume up and go higher.
In January, Jensen Huang said that useful quantum computers are likely 20 years away. Is he wrong?
I think that we're getting to the point, especially with this announcement, where we're years away, not decades away. And, I believe that part of what Jensen was referring to was some of those scale challenges that I mentioned in some of these technologies, the needing a warehouse size, computer to make it work. We don't need that. And so, but if you did need that, then you can imagine how it would take a long time to get through there. But from our perspective, the fact that I can put 1 million qubits on a chip that fits the palm of my hand, they're small, they're fast, they're digitally controlled. That means it's years, not decades. There's still a lot of work to do, but it's not going to be decades out. We're actually finding ways to accelerate even as we speak.
Microsoft Strategic Missions and Technologies EVP Jason Zander there, speaking with Bloomberg's Jackie Davalos. There's plenty more ahead. You're watching The China Show. This is Bloomberg.
All right, welcome back. So we're just moving into the 15-minute mark of the cash market session. So interesting note coming through on the Morgan Stanley. So they've finally dropped and exited their bearish China call with, I think it's an upgrade out of that. They've also bumped up some of their specific projections for some of the benchmarks you're looking at on your screens. I think we're at 24,000. If I'm not mistaken, I'll correct myself if I am, and if not already in my ear very, very soon from my producers. MSCI China is getting bumped up to 77. And really joining their peers in the industry. But yeah, we'll table the story for now and just pivot back to Australia, and really also central to this week's monetary policy bonanza.
That's right, Dave. Australia's labour market has extended its run of surprisingly strong jobs growth into the first month of 2025. Employment rose by 44,000 positions in January, more than double the average economist forecast. That follows this week's RBA rate cut, the first since 2020, but one that came with this hawkish outlook from the central bank. Let's get more with the Asia Trade co-anchor Heidi Stroud-Watts, who's standing by in Sydney with a special guest.
Such a special guest, Rebecca and Dave. Joining us now is the RBA Deputy Governor Andrew Hauser, and such a rare treat to speak to you, to speak to anyone from the RBA, so we appreciate your time. I think what that introduction sort of left out is the fervour that we felt, this sort of nationwide applause and sigh of relief. Do you feel like a bit of a rock star this week?
In terms of what? I didn't hear the introduction. Do you mean in terms of the labour data?
No, in terms of the first rate cut in 4 years.
Oh, I see. Look, I mean, central bankers are probably not the people you want to invite to your rave or your dinner party, to be absolutely honest. We're paid to worry, and we're paid to be serious about the economy. So I wouldn't say there was celebration in the RBA about this. We did what we always do and look at the data and try to form a view about where monetary policy should go.
Was there consternation, though? I do wonder in that room, how hard was it to get to consensus, given that there are still data points that would support a hold, perhaps in a different environment?
Well, look, it's interesting, isn't it? And I'm sure you're reporting this. The markets had formed the view that it was more or less a slam dunk, that this would be a rate cut. And the debate in the room, as Governor Michelle Bullock said earlier this week, was more balanced than that. There was, as there always is, an exchange of views about the case for a hold and the case for a cut. And as you say, there were factors on both sides. We reached clear consensus on the decision in the end. But I hope, and I think it would reassure you, and I hope it reassures markets too, that we're not sort of saying, oh, well, the answer's already there, so we follow the market and we just do what people are expecting. We look at the economics and we make a decision.
There's nothing predetermined about this particular trajectory of this easing cycle, I think, for any central bank at the moment. But it's interesting, we heard from the Treasurer saying that inflation is in the rearview mirror. With a lot of the risks, be they global tariffs and counter tariffs or election year spending, do you think that's going too far?
Well, I mean, the Treasurer can speak for himself. There's been a great deal of positive news about inflation in Australia. Just to remind you, and you know this, we adopted a somewhat different strategy to tackling the inflation spike in Australia to other countries. We raised interest rates to a level we thought that were restrictive, but we didn't raise them to the sorts of levels that other central banks had done, precisely because we wanted to protect the gains in the labour market. And as I think you've been talking about earlier, labour data out today show that the labour market in Australia has been incredibly strong, but inflation has also come down as well. What we said in December is that we would form a view about whether we become sufficiently confident that inflation would come sustainably back to target, to the midpoint of the target, 2.5, to begin easing. We did reach that position of sufficient confidence, but this is not a done deal yet. The underlying rate of inflation is still 3.2%, which is slightly above the band. The headline rate of inflation is in the band. And so although we've removed some of the restrictiveness that we had in policy, there is still restrictiveness in the system, and we still need to see a bit more good news on inflation coming back to that midpoint.
And the jobs data was quite nuanced, right? Because even though unemployment ticked up, even though we saw more jobs than expected full-time being added, participation is still really high. The wages data this week showed, further slowing. Does that tell you that some of that robustness might start to fade in the coming months?
Which bit of it shows you that it might fade?
That we're starting to see the signs of perhaps a little bit more vulnerability in the labour market. And of course, Australia's not the only one that's kind of dealing with that scenario.
It's quite hard to see bad news in the latest employment data. They remain very strong. I think the debate about the labour market is a slightly different one, which is, although we know employment has been growing strongly, inflation has been coming down. And as you say, wage inflation has been coming down too. And so there's a very lively debate about whether that employment growth leaves us with less capacity in the labour market or a bit more. If there is a bit more, then inflation will come down more quickly than we're predicting, and that'd be good news because it would mean that we can adjust policy more rapidly. But we need to see more information on that, I think, before we can be sure.
How does a change in immigration numbers potentially affect that, particularly with the labour market, but broader growth in general? Because we are expecting that regardless of who wins this year's election.
So I tread into issues of migration with some tentativeness as a central banker. Obviously, Australia, for long periods of time, has had a model of substantial immigration as part of its growth model and has done very well out of that. In terms of the inflationary implications for immigration, broadly speaking, our view is that it's a wash. So every person that comes into in general, people that come into the economy, they increase the labour supply, which pushes down on inflation, but they also have to purchase things, and they have to consume things, and they have to spend money, and that increases demand. And broadly speaking, you can debate the details, those two effects probably factor out, leaving inflation roughly where it would be otherwise.
I do want to get your view on the property market. I know it's not it's not an RBA topic, but it is a national obsession, of course, right?
I'm a renter, I should say. That probably immediately puts me in a certain category, but
whether you're
I've got nothing at stake here.
Yeah, but it is an ongoing problem, and it is something that feeds into the affordability and the cost of living crisis. Is there a balance there? Is there a policy to sort of balance that you can see?
Well, I think one of the quite encouraging bits of news in the latest decline in inflation is that some of those metrics, whether it's dwelling costs or rents, have started to come off, inflation in those two amounts. And that was one of actually the surprises in the undershoot of inflation that we and the market both saw in those numbers. And so some cooling there. I hesitate to say that, where this is going to leave us in 2 or 3 years' time. And clearly there are major structural challenges in the Australian housing market that I'm not going to wade into. All we can do is, take as an input our best read of what's going into the housing market.
So not 2 or 3 times, but 2 or 3 years in the future. But let's look forward to April, right? If I put it to you that the monthly CPI data that you get, maybe the 2 readings beforehand, show that first quarter trim mean is going to come in under the forecast from this week, would that trigger a move?
No single piece of data will ever trigger a news. We get a lot of a cut or a move. We get a lot of data in every month from surveys, from hard data, from our liaison people that are around the country talking to businesses. And our job is to put all of that information into a hopper and form a view about the outlook for inflation. clearly the inflation numbers are important. As you know, there are challenges with using the monthly data in Australia because the monthly indicators, they're not even called inflation numbers, are partial reads on inflation, and we only get a full 100% read on inflation once a quarter. That causes us to aim off a little bit from the monthly numbers. But look, I mean, if they come in weak, that will obviously be important for us. And as I say, I wouldn't quite say what's not to like here, but a world in which our forecast for inflation may be being a little bit above on the basis of the market curve, if we get news on the downside of that, that's a cause for celebration.
Do you envisage a challenge where rates stay the same because there is, of course, so much caution and uncertainty, inflation continues to come down, and you get that de facto financial tightening scenario? Is that a worry?
Well, it's interesting actually because our forecast, which shows inflation stabilising slightly above the midpoint, has got some interest. Point number one is that's conditioned on the market curve, which assumes that there'll be 3 or 4 more cuts. But one of the pieces of information that the board reviewed before making its decision was an alternative version of that forecast, which looked at what would happen if we held interest rates constant, which I think is your question. And under that forecast, and we didn't publish this, but I can tell you this is what it looked like. Under that forecast, inflation didn't stop at 2.7. It undershot the midpoint. Not by a lot, but by a little bit. And that factor alone was quite an important input into the board's decision. So holding interest rates constant would have led inflation to undershoot, and that was an important part of our discussion.
Where do you see the neutral rate at the moment? There's a note out this morning from CBA modelling and coming out with it being around 2.9% for the nominal neutral.
Well, there's a chart in in our report, our statement on monetary policy, that shows the range of estimates of the neutral rate, and it runs from something like 1 to 4. Now, 3 percentage points of difference in such an important macroeconomic variable is pretty useless, to be honest. It's far, far too vague for us to put a great deal of weight on that. We show that chart, I think, to make 2 points. One is that it is very uncertain, and if anyone ever tells you, and I don't think you'll ever get a senior central banker to tell you, I know what neutral is going to be, and it's 2.x or whatever, it shows how uncertain it is. But what they all show as well is that we're clearly restrictive. And there has been a debate about that too. You know, can you afford to cut interest rates if you're not sure you're clearly restrictive? We are sure we're clearly restrictive, both before the rate cut and now after it as well. But I would not want to put a number on it within that range.
Okay. Do you feel that markets, investors are on the same page as what the RBA is putting out now?
Well, I'm glad no, but they never are, right? So let me clarify what I mean by that. I spent decades of my life in financial markets, and I very much value them, listening to them, talking to them, being challenged by them, because markets, as you know, are not one view. There are many views coming together to trade to get to a single outcome. And so we learn a great deal from speaking with market participants, and we learn a great deal from market prices. If you look at the interest rate curve in Australia at the moment, you will see still price several further cuts. All we were saying in our forecast was that on our judgment, if you put that rate curve into our best guess about the economy, inflation is probably going to be a little bit above target. And so we don't have the confidence that the market does that number of cuts would bring inflation sustainably down to target. But let me be clear, we could be wrong. And I know it's sort of a crime for central bankers to say we could be wrong, but I think we should be doing it more often. And in this case, if we're wrong and the labour market shows it has more capacity and inflation comes through weaker, then policy will respond. So I don't think, I'm not abashed about that point. Clearly, the market currently thinks that there will be greater capacity in the market. That's not our central view, but it might be right. And if it is, we'll learn from it.
To that point, Governor Bullock says that she's more of a glass half full person, that you're more of a glass half empty person. So
she said that, did she?
Yes, she did. She did, quite recently. And I guess my question to you, as I guess, you know, perhaps a resident pessimist, if that's how she's characterising you, what do you see as the biggest risks facing the economy?
I'll tell you why she said that, actually, because she was given, you may know this, by Phil Lowe when they handed over a cup that I think was his, which said glass half full. And I thought it would be rather funny to get a cup that said glass half empty. She didn't actually think it was very funny, so I'm not quite sure about that. But anyway, in terms of risk, look, I mean, number one, I'm going to be boring, but I'm going to say it anyway. Our focus is still rigorously on inflation. There are risks in both directions to inflation. We spent most of the interview talking about that. We're not going to somehow start worrying about other risks in preference to that. That's our number one focus. We talked about the uncertainties around the labour market and the possibility that there is greater capacity. That would be a good risk to have if it happens. We haven't talked yet, I guess, about the global economy, and perhaps that's where you're going. Obviously, things are changing. And I think, number and I'm sure you spend a lot of time talking about this on your show. Anyone who tells you they know how this is all going to shake down in the long run is wrong, right? We're all learning. Things are moving very quickly. I think one of the important points I'd say is actually that very uncertainty about trade policy and about outcomes in general, globally, not exclusively in Australia, may itself have an effect on activity in Australia. So if you're a firm or if you're a household planning to make an expenditure that in some way depends on a certain outcome in the global economy, and you know that who knows what's going to happen in the next period, you might just wait. Now, waiting is very sensible for an individual, but it could be really bad news for the economy. So I think, for me personally, one of the factors in the decision this week was actually a sense that, look, maybe that pervasive uncertainty itself may have some short-term depressing effect on activity. If you want to think about how the various initiatives that are being mooted around tariffs and non-tariff trade policy are going to affect Australia, there's a huge range of outcomes, really huge. How big are the tariffs going to be? What are they going to be faced on? Will there be retaliation? Will it be in the main economies that we trade with, or will it not be? You plug those various uncertainties into a model and you can get almost any outcome. It's not good news for Australia if there's a widespread depression in global activity. That's not what the financial markets currently expect to happen. But Australia has thrived when the global economy has thrived, and it's struggled when it hasn't. So we are very reliant on continued good global activity. The implications for inflation are less clear. Normally, if you impair the supply side of the economy, you'd expect inflation to rise. However, if it cuts demand, inflation may fall. So although I think it's pretty clear that, tariffs, if they push through and they have a material effect on global activity, will probably reduce activity in Australia, its impact on inflation is less clear. So, everyone is crunching through numbers. We have a section in our latest report that talks about various scenarios. But the truth at the moment is you pay your money or you take your choice. We are waiting to see how this evolves.
Is it more of a broad global risk for you, or is there still specific risk when it comes to China? Because, traditionally, Australia's growth has relied so much on the strength of China. We know that they're moving away from industrial production from the property market. That's not going to improve meaningfully anytime soon. Does that have strong implications, or are we well diversified?
It could do. I was sort of talking about this with your colleague earlier. I think if you look at Australia's long history, Australia has actually been incredibly effective at responding to the changing shape of demand in the global economy. You talk about traditionally our links with China. Of course, that's true in recent years. But if you go back 20 years, 30 years, 50 years, 100 years, Australia has actually specialised in a whole series of different activities and done very well out of it, based on where the demand in the global economy is. If the demand in the global economy moves on from steel being sold to China, then Australia will need to think about adjusting in that respect. And as I say, I have some optimism, actually, this is not glass half empty, that Australia will respond to that in due course. But look, we are keeping a very close eye on Chinese activity, as I know you are too. It's been challenging in China in recent years with the demand growth and the adjustment in the property sector. One thing I would say is I think steel production and iron ore exports, therefore, from Australia have held up probably surprisingly well. 2 or 3 years ago, you could see all sorts of people drawing charts with big lines going down. Peak steel's far behind us. Actually, demand for steel has held up. And we have people in China who are based in the Australian embassy there and go around and talk to a very wide range of Chinese businesses and thinkers and academics and policymakers. And China's been quite clever about diversifying itself in its use of steel away from the traditional uses and towards, data centres, for example. Let's suppose we all go AI. Well, you're going to need a great deal more data centres. That still needs steel. So the death of steel is probably, foretold a little bit too early sometime. But look, if we have to adjust, we'll have to adjust.
Before we go, given the confounding global circumstances and challenges, would you rather be a central banker here in Australia or at the BOE?
I'd rather be a central banker here, actually. It's been a fantastic year so far, and it was quite lively back in the UK. I was at the centre of the LDI crisis a couple of years ago, so a little bit of calm could be helpful. But this has been a huge privilege to come here. It's quite rare for non-nationals to be asked to be senior policymakers in a central bank, and I've hugely enjoyed it. But it's also a very important responsibility that we're all being given to try and navigate Australia through this difficult set of circumstances. And look, the ability to live in Australia, to live in Sydney and travel around this great country is brilliant, to be honest. And so, no, yes, I am glad, and hopefully Bloomberg doesn't reach the UK, does it? Andrew Bailey won't be watching this, I'm sure. But if he does, sorry, Andrew. But, yeah, no, definitely an upgrade trade.
Well, it's been enormously fun having you with us. We really appreciate your time. The RBA Deputy Governor, Andrew Hauser, there. Dave.
Yeah, well, we can let Andrew Bailey know because we speak to him as well following rate decisions. So just in case he's not watching, what time is it in the UK? 4 in the morning. We'll pass the message on. There we go. Fantastic conversation there with Heidi and the RBA there just now. In case you missed that, you can scroll back, of course, on your TV Go function for our Bloomberg clients. And you can also join the conversation by sending us instant messages. You know how to reach us, of course, here on our shows. Okay, as they were discussing all things RBA policy, housing market, he's a renter, according to the Deputy Governor there. Air Force One is on your screens. This is, I believe, a live shot out of Andrews Air Force Base. And I believe we are waiting for the U.S. President. And there he goes, coming out right now out of Air Force One. He is speaking with reporters aboard Air Force One. We are getting more headlines coming through, by the way. Out of that, let me just bring up my relevant Bloomberg screen. And Rebecca, go for it.
So a reporter asking him about this potential new trade deal with China, and his answer that it's possible. So there we go.
What do we do with that information?
I mean, I suppose in a way, at least this does chime with the kind of more slowly approach that we've seen from Trump so far. A 10%. We're still waiting to see whether or not we get any higher. But to that whole question, I mean, we had Eva Lee from UBS on just earlier with her consensus that we get to 30% through this year. And by and large, that is the expectation here, that we somehow find our way, perhaps it's gradually, perhaps it's all in one go, to 20 or 30% when it comes to these China tariffs. Yeah, being put in a position to react, I think, from a corporate strategy is really, if you think about it, the most you can do, given that it could happen, it could not happen. It may happen. If it does happen, you don't know when it's going to happen and how long it's going to be there, too, on the tariff front. And these constant fluctuations. Will it, won't it? There's optimism, there's pessimism. The whole roller coaster and gamut of feelings. Yeah, there we go. So from Air Force One, the U.S. president there, we'll leave that shot there for now. And really just the perfect resource, Speaker, to just help us understand the context here between the U.S. and China. Cameron Johnson is senior partner at China-focused market research firm TidalWave Solutions, and he's with us here, of course, on set. Nice to see you, Cameron. Good morning.
Thanks for having me in, guys.
What's the advice to corporates trying to figure this out?
I think the reality is corporates have to distinguish what's the pageantry of Trump, right? Tariffs, we're going to blockade, we're going to do this, we're going to do that, versus the reality of Trump, which is really a pragmatic, refined approach depending on industry and country, right? For example, we saw this with the levying of the 10% tariffs for Chinese goods. It wasn't over or too much. China responded in a soft manner, leaving room for negotiation, and at the same time, we see the rhetoric is fairly positive, right? Trump, of course I want to do a trade deal. Who doesn't want to do a trade deal? And so I think when corporates look at it, they have to look at more of the reality of Trump. Where exactly are the specific things that he's looking for, and not be too over-reliant on what the worries are.
To your point about being able to distinguish between the pageantry and the real risks, are you seeing any evidence that China, in response, is taking a somewhat softer approach to Trump?
Absolutely, it's a softer approach. When we saw they put 10 to 50% tariffs on oil and natural gas, well, the reality is there's not much of that coming into China already. So they targeted an area that wasn't as important, right? They did put more export controls on, though, for example, on tungsten. And that's more of a signal of, hey, guys, we also have things that you need, and we can also bring pain if we want to. But remember, it wasn't a ban, it wasn't an outright restriction, it was this is the roadmap we're going to follow. So it gives room for both sides to actually figure out what to do moving forward.
Are businesses actually concerned? And the reason I ask you that, businesses in China concerned, and the reason I bring that up is, you mentioned that, there's very little exports anyway to tariff. If you look at the other side. And I'm wondering whether Donald Trump is actually using the correct threat to get the counterpart to do what he wants.
I think part of it is there's a challenge in differentiating what is the actual pageantry versus the reality, even on the mainland. Again, we're going to tariff everything. We're going to stop you from being able to do this. Well, of course, companies are going to go, wait a minute, now I need to put up warehouses in the Middle East, right? For example, for those who are doing fast-moving goods through Temu, as an example. Now I need to have producers in Vietnam. Right. So that's the reality. But the actuality of it is Trump, for example, clawed back the executive order on de minimis and said, wait a minute, we're going to take some time and actually review this moving forward and, again, give that room, that buffer. So what businesses are trying to do is anticipate that. So this is why you see the Shein move, the Temu move, and others. So if it doesn't happen, they're still okay. But if it does happen, they at least have a roadmap on how to move forward.
We've seen U.S. firms operating in China kind of double down. The ones that are already there are there sort of to stay. But what we have also seen is that new investment, and this goes globally for foreign firms, inflows falling to their lowest in more than 30 years. What I want to ask about Chinese firms operating in the U.S., what strategy are they approaching to sort of try and stay out of the crosswinds and the crosshairs of U.S.-China tensions?
So a lot of companies are not actually investing in the U.S. yet. What they are having feelers out. They're meeting local officials. They're meeting U.S. government officials to see where is there room for growth, where can I actually go, where can I have success. Most of it at the moment seems to be focused on more greenfield investments because those are kind of, you can start from scratch versus trying to acquire a company or something that may cause you problems. The other thing is we're seeing more of an understanding of how the U.S. actually works, for example, the lobbying system. So you're seeing more companies actually hire lobbyists in D.C., also lobbyists in state capitals to work with local governments or state governments to, again, understand not just policies, but what are the concerns overall of the government so they can address those.
I just want to ask that lobbying question. Do you think that any Chinese firms have sort of been caught on the back foot? Are they sort of skilled up? They have the lobbies, they have the advisors they need in place, or is this still kind of a work in progress?
I think it's a work in progress. It's very much when U.S. and European firms came into China, right? You have to understand the system. The system's been around for a long time. Some people don't know exactly how to maneuver and address it. So you are seeing some of these teething issues. But the good news is with Trump and his signals, there is a lot of attraction to going into the U.S. market. So what they're essentially waiting for is find me a couple good use cases of companies, Chinese companies in the U.S., then we're going to go. Then you're going to see a flood into the U.S.
And, a lot of Chinese companies are looking outside for growth. We keep talking about EVs as a good example. Without naming names, there are a lot of other sort of consumer-facing companies that are looking to enter the U.S. markets. And the reason I bring that up is you have some props there. Do U.S. consumers actually care where the stuff is made, for example? Like how much does that actually resonate among consumers?
So this is a beautiful lint roller. I used it this morning to kind of, take care of myself. The reality is this is $1. So does a customer care where this comes from? No, nobody cares. All I want is cheap and it's a throwaway so I can use it, right? If you put a 25% tariff, 50% tariff, now it's $1.25, $1.50, does that change the calculus? Will manufacturing come home? The answer is no. When you're looking at manufacturing, it really is heavy manufacturing. We want to be able to make automotive parts here. We want to be able to make batteries here. We want to refine materials here so we have better control on it. That's where consumers and the government is looking. They're not looking necessarily for these kinds of things.
But that's not a tariff, though. That's industrial policy, right? A factory takes 5 years to build. Look at the Chinese example. Why do we have DeepSeek, right? That's an industrial policy that's gone back a few years. Does the U.S. need to look inside rather than tariff everybody else?
To some degree, I think part of it is also the ecosystem you have to build out. Right. I look at the ecosystem of 5 key components: advanced infrastructure, talented and educational apparatus, technology, government support, and raw materials, right? So you need those 5. China has 5 of those, all 5, in abundance in most industries. The U.S. does not. So one of the areas, for example, the U.S. is struggling in is its electrical grid, right? China added 380 gigawatts of capacity last year to its electrical grid, including green energy. The U.S., 60, including green energy. So China added 6 times the capacity in 1 year. they're going to dominate AI because now they have all of the energy you ever need. You want a data center? No problem, we can handle that. You want more electricity for universities, for training? No problem, we've got to handle that. Oh, you need new factories so you can build out more materials and machines and everything? We can do that too. The U.S. is stuck and they can't handle that. So when you actually look at the entire ecosystem, that's why China at the moment is leading the AI race. It's not just about give me a beautiful app or program, it's about the entire ecosystem and how it's positioning it.
As we've just discussed, industrial policy in China is not just years in the making, it's decades in the making. Yeah. And yet DeepSeek seemed to take so many in DC by surprise. Do you think that policymakers in the US are at risk of underestimating the ability of China to innovate?
I think that's been the case for over a generation, right? I've been here since I was a kid, and every year it's China's going to collapse, or China can't do this or can't do that. I think the reality is in today's world, because we're a globalized, connected world, right? If China can't find it, they're going to find it in Southeast Asia or other places. That's how they're fueling their actual build-out.
I'll ask you some more specific. Like, what is the risk to the type of US policy that we have towards China now? This underestimating China's ability to innovate. How is it risking its export policy control, for example?
I think when you don't have the accurate information, you're going to make mistakes, right? And that's what we're seeing now. We're going to put on chip controls, and because that will keep China a couple steps behind us and we can continue to innovate and be ahead. Well, that's not the case, because now you force the ecosystem in China to become not just more efficient, but more focused, right? Never focus China on a problem, because if you do, they will attack and kill that problem, right? On the other hand, part of the challenge in D.C. is a lot of people have not been to China since before the pandemic. There's not enough Mandarin speakers. So, for example, when I go, I watch and read supply chain literature on the mainland religiously for my work. When I go to D.C. or even to Europe and talk about it, they have no idea what I'm talking about, because the literature I'm looking at is only in Chinese. And so, to your point, it's not just one single cause. It's a whole plethora of problems that are contributing to not just an underestimation, but what do we actually do? How do you actually have a strategy to China when you don't understand what's actually going on in the country?
Okay. Cameron Johnson, thank you so much for joining us. Such excellent insights there. Senior partner at TidalWave Solutions. Stay with us. There's plenty more ahead. You are watching The China Show. Three Chinese warships have been spotted in international waters off the coast of Sydney. The Australian Navy is shadowing the vessels, which were reported to be some 150 nautical miles off the coast. Bloomberg's Australia government reporter Ben Westcott joins us from Canberra. Ben, tell us first, what details do we know so far about this?
Sure. So far, the Australian government has been a little cagey about letting out too much information. But what we know is that it's three vessels. It's a guided missile cruiser, a replenishment vessel, and a frigate. And they have basically been spotted. They're off the eastern coast of Australia, which is quite a long way away from the Chinese shipyards in Shanghai. But the interesting thing about this is that it's very, very rare to see Chinese vessels off the coast of Australia, particularly the eastern coast. In the north, near Darwin, off the coast of Indonesia, that's pretty common. But to see them near Sydney, near Melbourne, that's very unusual.
Yeah, Ben, and I think just to make the other point too, where we do see this slightly more common is really around the South China Sea. And I think a related story here is the Philippines. And what do we know about this? Accusing, at least based on what we're hearing from Manila, a Chinese chopper of dangerous maneuvers. What do we know about that?
Yeah, that's right. So the Philippine Coast Guard has accused China of flying within 3 meters of one of their helicopters, and I think it's not unusual for anyone who follows this sort of news regularly. It might be dangerous, but it's not unusual. Australia has itself, in fact, just accused China of doing a very similar maneuver in the South China Sea, where an Australian plane had flares shot into it from above by a Chinese plane. And now, in both these instances, I think we know that the Chinese government says that it is not the Chinese military's fault. It's the fault of the militaries in question, the Philippine military, the Australian military. But as I say, these things are becoming not uncommon. I think there's been at least 3 incidents with Australia in the past 18 months, and more than that for the Philippines, particularly around Scarborough Shoal, where this particular incident took place.
Ben, thanks for the update. Ben Westcott, there, our Australia government reporter on the latest there on this specific front. In fact, let me just pivot on that, use that as a jumping off point for this group of stocks moving right now. Some of these defense names on your screens right now on the down. So you have a budget cut, of course, plus, of course, some of the other related stories. It's an opposite story when you look at some of the Chinese defense-related stocks, for example. We can get to that, I think, another time. Right. Big earnings day today. You have Alibaba, you have NetEase, Bilibili, and Lenovo. Just among the companies reporting today, and suffice to say, Alibaba will be taking a lot of focus given the run-up in the stock. Split the difference, so up 50% going into today, down about 3%, so we're up about 45% year-to-date so far. Despite that, the stock is still about 1 standard deviation below its historical mean, so things have become relatively expensive, but overall things do remain relatively cheap, historically speaking. So, yeah, that should be out right before the U.S. markets open. And just very quickly, I guess, on the Japanese currency, just pay attention to this, because when this moves like this, and if it takes out the 150 handle, this could remind us of some horror stories that we had back in August of that carry trade. I'm not saying we're there, but certainly when you have a conversation on the BOJ might needing to move interest rates, should be, I think, very much in focus for macro traders out there.
Yeah, but also watch today. We have US Treasury Secretary Scott Bessent joining Bloomberg surveillance. That interview is happening at 8 p.m. in Hong Kong or 7 a.m. if you are in New York. That's it for the China Show. Insight with Haslinda Amin is next. This is Bloomberg. Stay with us.